Adrienne Buller is the Senior Research Fellow at the Commonwealth think tank and author of the new book, The Value of a Whale, on the Illusions of Green Capitalism. Adrienne, welcome to the Climate Pod.
Thanks so much for having me. It's great to be here.
So what made you want to write Value of a Whale?
Oh God, it's a good question and a bit of a lengthy one. I came to the kind of climate and finance space a few years back, working for a really excellent organization called Influence Map, and they track corporate lobbying on the climate crisis. And I did a lot of work there on the role that the financial sector plays in both enabling and trying to address climate crisis. And really interesting, got exposed to the way that, the financial sector is thinking about this issue, and also came away from it like quite disillusioned, I think. Not so much at, there's a lot of really well-meaning people trying to do good stuff, but just kind of disillusioned at the kind of systemic obstacles to actually getting change through kind of like private financial markets and private investors, and also just wanting to work on, finding more kind of equitable and, in my view, kind of democratic ways to address these kinds of challenges.
So the book highlights lots of problems with green capitalism. So first, how do you define green capitalism?
Yeah, so it's a big and expansive term, and I'm sure there'll be other people that probably define it differently. But for me, I think it comes down to sort of an observation of two key trends in the way that I think a lot of the private sector, so finance and corporations, but also increasingly a lot of policymakers and governments and kind of international institutions like, the UN Environment Program, et cetera, are thinking about how we respond to the climate and nature crises. And it comes down to two sort of key tenets, one of which is, to me, it appears to be a response to this unprecedented threat to capitalism, where the solutions that come out of most of these bodies are really centered around trying to minimize any kind of disruption to existing systems, distributions of wealth, existing economic systems, distributions of power. So really trying to kind of like cement our economy as it is while sort of decarbonizing. So this kind of imagined future where nothing really changes about the way that we organize our economy, except for our reliance basically on fossil fuels. And the second part of it is, confronted with this huge threat to profits and financial returns. For me, green capitalism is this like substantial effort to try and either find or more often than not sort of create artificially new domains to sort of profit and accumulate as we shift to a decarbonized and more sustainable economy.
For those advocating these green capitalist solutions, what are the promises that, in regards to decarbonization and environmental sustainability?
Yeah, so I think a lot of this comes down to this like very prevailing mindset that we have, particularly if you are from a North American economy or from the UK. I mean, I'm originally Canadian. You can tell I'm not actually British, I'm sure, but anyone who, has grown up in one of those kinds of places or throughout Europe, there's this very entrenched mindset about, I think, the efficiency of markets and the price mechanism as this kind of optimal arbiter of information and, the best way to organize our economies. And also, this myth around it being the most innovative and sort of efficient way to solve problems. And so I think, advocates of market-based approaches, whether that's, a sustainable finance type solution or whether that is, carbon markets, I think genuinely really see in those proposals a very cost-effective and efficient way to solve this problem. And, most very prominent climate economists, so William Nordhaus is a really good example. He's probably the most prominent kind of figure in that space. He talks about efficiency and particularly cost efficiency as, being the kind of breakfast, lunch, and dinner of economists. And carbon pricing is kind of the totemic way to address this problem with perceived efficiency. In as much as it's all about finding kind of the lowest cost ways to cut carbon. Whether that actually correlates with like material impacts, and by that I mean, cutting emissions quickly and permanently and durably, or achieving a more sustainable economy for the long term, and particularly doing so in a way that is fair and equitable is another question. But that, I think, is the big promise for advocates of market-based solutions to the climate crisis.
Yeah, I mean, emissions reductions, that's the point, right?
Yeah.
So in practice, have the results of green capitalism actually backed up those claims?
I mean, so no would be my big take, I guess, and one of the key points in the book, which is that, a lot of these are basically predicated on big assumptions about the way that markets work and their ability to solve problems. And obviously, we're unfortunately and very regrettably in the relatively early stages of actually starting to implement a lot of these policies because, as we're all well aware, have delayed and obfuscated for so long. But carbon pricing, again, I'll come back to it, is a really good example. So, for the European Union, the emissions trading scheme there is sort of the flagship policy that they have. And it's kind of quite celebrated around the world for being one of the first sort of widely enacted and perceived as successful cap and trade kind of mechanism. And the sort of official figures that come out of the European Union on that cite about 40% emissions reductions from that program, which sounds amazing. But in reality, it's sort of those 40% only count for the actual sectors that it covers, which is quite a narrow set, in large part because, it was politically controversial and there was a lot of lobbying to be excluded and there was a ton of free permits handed out to various industries. So there's really interesting work done by an academic called Jessica Green, who I cite in the book. She's a Canadian academic, which shows that, the actual kind of overall emissions impact of carbon pricing in the EU has been much smaller, like on the order of 1 or 2%. I think I need to check that exact figure, but generally carbon pricing schemes, for all of the hype around them and for all of the political energy dedicated to them as this kind of core principle and approach, have delivered like fractions of a percent of overall emissions reductions over their tenure. And that, I think, is really emblematic of a lot of these solutions, right? We've spent a lot of time finding out ways to construct new markets to solve problems related to climate and ecological challenges. Huge amounts of effort determining, what prices should be. So again, there's all these estimates about what an ideal carbon price would be, and they range from, $40 a ton all the way to $14,000 a ton, depending on, how stringent you want to be about climate scenarios. And as of 2020, the actual average global carbon price stood at about $2, I believe, according to the International Monetary Fund. So there's this idea that these are efficient and easy solutions that kind of sidestep the messiness of the politics around direct regulation. But in reality, I think they end up often being much more complicated in terms of the amount of political and public effort required to set them up. And they don't really deliver materially on what we need to be doing. The EU ETS, again, I'll come back to it. A lot of the gains it has made are temporary because they derive from, for example, shifts from coal to fossil gas. That's really effective in the short term, but is still a temporary solution. And so all of them, I think, my big concern is that, even if we have little gains, we'll spend years, and a ton of effort on these, when in reality, they're mostly, I think, a distraction from, the actual kind of approaches we need to be taking, which for me would be, much more direct than a market-based approach.
Yeah, they don't have the substantial impact that we need, and they're really hard. Even these, somewhat simplistic carbon pricing schemes are really hard to pass. So if that's the case, why do you think green capitalism is growing more and more popular?
Yeah, well, I think there's two answers to that, right? I think there is one camp that is quite earnest and genuine and is you can do well by doing good. We can find business solutions to this, ways to be, profitable while actually delivering outcomes. And that's definitely a group of people. But there is also, I think, quite a lot of cynicism in this space. And I touch on that in the book a little bit as well. So there's, this unbelievable example from a couple of undercover journalists from Unearthed, which is a publication, I believe, created by Greenpeace. But they went undercover on a call with ExxonMobil sort of PR representatives who basically said, in not quite so many words, ExxonMobil supports a carbon price, a huge pivot from a few years ago. But, ExxonMobil supports a carbon price because it's never going to happen. And they know that if it does happen, they can probably, lobby in such a way as to enable themselves to have, very minimal kind of hurt from the actual process. And so I think, there's two sides of it, right? One is this like genuine adherence to the idea that markets are incredibly efficient and therefore, that's the only way we can do this. And the other, I think, is the conventionally more kind of cynical, villainous route, which unfortunately remains, not a fringe group of people.
Yeah, I'd say touching on the cynicism of green capitalism, that might be somewhat of an understatement based on the book. But I want to talk about ESG funds later in this conversation. But before we get to that, I think we need to get just kind of a foundational understanding of asset management, because asset managers are now playing a larger and larger role in the global economy. So what is asset management and how has it grown over the last couple of decades?
Yeah, so asset management kind of does what it says on the tin. So basically they're big companies that will take your assets. So whether you have some savings that you want to invest or whether you're part of a pension scheme or whether you're a university endowment, and they'll take those assets and they will manage and invest them on your behalf. So they'll use their sort of expertise to decide how to build a portfolio for you that can get, the optimal kind of risk return ratio for what you want. And they just basically do all that investing work for you. A large part of the way they do this is through funds, which are basically just pooled vehicles. So you might have the assets of, 1,000 people in a single fund. And that allows you to buy up a whole range of assets, whether it's stocks or bonds or, real estate, anything really. And that enables you to, again, sort of invest across the whole economy. So asset managers kind of used to be traditionally just the domain of like the wealthy. But over the past several decades, and particularly since the financial crisis in 2008, they've really like exploded in scale. And not only in overall scale, but also in terms of concentration in the industry itself. So today we have a system that is like almost entirely dominated by a handful of like absolutely massive firms. So you've got BlackRock, Vanguard, and State Street at the very, very top of the pyramid, who many listeners may have heard of, particularly BlackRock, because they like to have quite a public-facing image. And together they control $20 trillion in assets. That's 20 with 12 zeros on the end. It's absolutely enormous. It's also, a full fifth of all the assets under management of the entire global asset management industry. So you've got thousands of firms, but 3 of them control a fifth of all the assets. And together they now own an average of 20% of any given S&P 500 companies. So that's Amazon, Facebook, Pfizer, all the big ones that you can name. It's the 500 biggest US corporates. Picture's quite similar in the UK as well. On the London Stock Exchange, they are also the dominant players. And it's kind of completely changed the way that corporations are kind of owned and governed from, this old-timey image we might have of like mom and pop buying shares in a company or a pension fund to these highly specialized professional firms in a hugely concentrated industry, investing on behalf of millions of people, often without any kind of direct input from those people, whether that's you or I with a pension fund or someone buying a BlackRock fund, without really any of our input on how they should be using our assets. And a big part of that is that when you buy shares in a company, in a corporation, you become entitled to sort of governance rights at that corporation. And this is really big in the case of the climate crisis, because there are lots of votes every year at corporations where they might decide, should we set a net zero target? And as an asset manager, if you're holding those shares, even though they were bought with our money, the asset manager gets to have the discretion about how to vote those shares, and they end up with a huge amount of influence at the corporations that they are shareholders in.
And you also talk about in the book how even this industry has evolved. You talk about the growth and the prominence of passive funds.
Yeah.
What's the difference between active and passive funds?
Yeah, so we kind of have this like image, I think a lot of us do, of Wall Street investors in the kind of Wolf of Wall Street sense, these kind of team of managers all yelling and doing the research and deciding what to invest in to try and beat the market. But again, particularly since 2008, and this is what has hugely propelled the rise of groups like BlackRock and Vanguard, is passive investing. It's also called index tracking investing, which I think is helpful because, again, that describes exactly what it does. So rather than having a person or a team decide, individually picking stocks, an index is basically a predetermined list of the securities that you should buy. It tells you what to buy as well as the relative amounts of everything that you should buy. And either of those are constructed in-house based on like a criteria like the S&P 500, which we've mentioned already, or you might say, I want to invest in like global mining stocks, and you just compile a list of the whole mining industry worldwide, something like that. Or a lot of the time, those lists are, again, produced by sort of these external firms. And again, there's three of them. For whatever reason, we love having a big three, no matter what the industry. And so that's S&P, MSCI, and FTSE Russell. And they absolutely dominate the industry of providing these indices to asset managers. And that all sounds quite technical and maybe a bit boring, but I find it quite interesting because it's totally changed the way that decisions are made in the global economy in terms of how we allocate investment and in terms of sort of where power sits in that decision making. So today, the top managers are all primarily passive. Vanguard is almost exclusively investing passively through its trillions of assets. So all it's doing there is just, tracking an index and tracking the market. So instead of trying to beat the market, it'll just say, if S&P 500 goes up X%, then so will I. And it's become hugely popular in part because it's so predictable, or at least, you're going to just track the progress of the market itself. You're not going to underperform it. And it's also a lot cheaper because you don't have a team of people, making all the decisions. And so it's become hugely popular. It's a major part of the way that we allocate investment today. In the US, I think it's more than half of all assets now are passively invested. So it's overtaken active investing, and the UK is quickly following suit. And so it's a massive change in the way things are invested. And it definitely has implications as well for how we think about finance's role in the climate crisis.
Well, the allocations of funds, that plays a really important role here. So how has the prominence of passive funds impacted how money flows to clean energy companies or startup companies versus the big incumbent fossil fuel companies?
Yeah, so there's a really interesting kind of quirk to passive investing, and it's documented really well in this excellent book that I highly recommend to listeners. It's called Trillions by a journalist called Robin Wigglesworth, and it's quite nerdy. It's a history of the index fund, but if you're interested in this at all, it's great. And he explains really, really well the mechanics of the way that passive investing has this risk of kind of favoring large incumbent firms and potentially crowding out smaller upstart firms, which often typifies, renewables companies or other kind of like small innovators. And in part, that's just because, it's based on a set of criteria for an index that often is built around size. So you have to be in this industry, you have to be X number of years old, and you have to be, this large. That might be a set of criteria. And that in and of itself, tends to favor big existing firms. But even the way that the money works in an index fund tends to favor these firms as well, because the way that it happens is you have the list of firms, but then the amount of money that you put into each is in proportion to the size of the firm. So if you're buying the S&P 500, you're putting way more into, Tesla and Facebook than you are into Alaskan Airlines or, Hasbro or whoever's at the tail end. And so you do get this kind of self-fulfilling prophecy element when it's at a large scale that tends to favor incumbents, and fossil fuel firms are a really big part of that. There's also been some interesting trends, and we've done some research on this at Commonwealth where I work, that shows we've started to see, at least in the UK context, that active investors have started to move out of the fossil fuel industry very slowly. nowhere near fast enough, but they've started to move away from it. And in their absence, passive funds are actually slightly increasing their holdings and are becoming kind of holders of last resort, which is this term that campaigners have used for a long time. And they've been sounding the alarm on the fact that, because indices are inherently backward looking and because they tend to reproduce existing trends in the economy or existing arrangements, for example, fossil fuel firms being big, that they can sort of have this prolonging effect potentially on the fossil fuel industry's sort of access to investment. And what's interesting as well is that, passive investing has become so huge and many of these indices so influential that they're not just tracking markets anymore, but they're actively sort of moving and changing them. So you can have, instances where there's whispers of a company getting added to an index and its share price is hugely inflated overnight. And the same with it potentially being bumped out of an index. And so that has really material effects on the way that people behave. And there's also an interesting trend with bonds, which are a form of like debt instrument, basically. And there's evidence showing that the rise of passive investing has driven companies to issue more debt, issue bigger debt, so like more valuable bonds, and issue bonds with longer maturities. So that means, they have a longer time horizon for borrowing. And if you think about that in the case of fossil fuel companies in particular, that has potentially really concerning implications insofar as, they're borrowing more for a longer time period and, creating the risk of stranded assets if you are an investor and that's what you're concerned about, but also creating, a risk towards having, investment and financing for a long way down the line when, obviously we need to be, I think most people would agree, rapidly scaling down the fossil fuel industry if we want to secure a habitable future. And the last thing I'll say is that beyond fossil fuel companies, passive investing also applies to forms of government debt. So a lot of the poorest countries in the world have to borrow on international markets to get financing to fund their government and all the activities that they need to do. And private investors, particularly through index tracking routes, are a big part of that. But unfortunately, one, it's often more expensive to borrow from private companies and private investors. And two, there's research showing that passive funds in the event of a crisis, so like a cyclone or any of the acute crises that are going to punctuate the climate crisis going forward, they're more likely to rapidly exit that government debt and to do it quickly than other types of investor. And that has really, really devastating implications for the governments who've been borrowing, because it immediately drives up their cost of borrowing at a time of crisis. And that has huge implications, not only for their ability to address that immediate crisis, but it also leaves you with more expensive debt in the long run, which means you're probably going to compromise both mitigating and adapting to the climate crisis in order to finance essential day-to-day kind of governance activities. And so all of this is quite an interesting, I think, arrangement of power and of the way that money is flowing. And I think, people aren't really talking about it to the extent that we should be. But yeah.
Yeah, and so much of it is the concentration of power, right? Like you talked about earlier, you talked about BlackRock. They always, that Larry Fink investor letter always makes a lot of news when he talks about sustainability. It makes news, and they're enormous, right? They've got over $10 million in assets under management, and they're shareholders of the world's biggest companies. I mean, have they used that power that they have, that they've now concentrated? Have they used that to force management to actually change their ways and make climate conscious decisions?
So yeah, BlackRock is such an interesting example because, as you rightly say, they are the biggest investor in the world, $10 trillion corporation. They're also a universal investor, which means, as you said, they're invested across the entire economy. That's not just shares and bonds, but, they own a huge amount of real estate. They own tons of other assets. And so they are, as a result of that, uniquely exposed to the impacts of a systemic crisis like ecological and climate crisis. So there is a legitimate point to be made that they are actually concerned about the advancing climate crisis, because it does threaten their kind of financial returns and profitability. And Larry Fink, as you said in his letters, will talk about the importance of investing with the climate crisis in mind. But I think, he also interprets that through a very, very narrow remit, even though, there have been all sorts of accusations of Larry Fink getting too woke and, woke capital. I think he would reject that and say, his approach to it, and this is the approach of a lot of sustainable investing, which I think we'll probably unpack a little later, is, I will do whatever I think is the safest in terms of minimizing the impact of the climate crisis on financial asset values and returns, and not necessarily minimizing, the advance of the climate crisis itself. And that's a really critical distinction, and one that kind of underlies the way that the financial sector is approaching the climate crisis. And sometimes those things might overlap. Minimizing your financial risk might involve, actually reducing the climate crisis or slowing it. But that's not necessarily the case. And I think BlackRock is, again, really aware of that. And that's why a lot of BlackRock's efforts related to the way it approaches climate is actually dedicated to the policymaking space and to politics more formally and more directly. So BlackRock is incredibly interested in politics and politicians. Larry Fink has been accused in the past of creating like a shadow government, which sounds quite shady, but is true in some ways. He was quite close to the Obama administration. He's quite close to Hillary Clinton, and there are now a number of prominent BlackRock alum who are in the Biden administration in quite senior roles. So Brian Deese worked with the Obama administration, then went to do sustainability at BlackRock, and now is an economic advisor to Biden. Mike Pyle, who was also a senior director of investing, I can't remember his exact title, but very senior executive at BlackRock, is also now working in and with the White House. And there are a number of other examples of, former central bankers that now work for BlackRock, or the reverse. So, George Osborne, the former UK chancellor, got a really cushy gig there. And there's this incredibly effective kind of courting of influence in the political sphere. And, the imprints of that are really direct. It's not just kind of like wine and dining and enjoying being around politicians. BlackRock was invited to advise on drafting the European Union's sustainable finance regulations, and that was investigated by the EU Ombudsman for, corruption adjacent type issues. And similarly, when the pandemic hit and the US Federal Reserve undertook a huge program of buying up corporate bonds to kind of keep businesses afloat and keep financial markets afloat, they gave that huge task to BlackRock rather than doing it themselves. So BlackRock got to decide where that money went. And in the process, they bought up a ton of their own funds. And then, in recent legislation with the Biden administration, you can kind of see the imprints of private finance on the way the legislation is drafted. So the infrastructure bill is a great example. Larry Fink is a huge proponent of what he calls, public-private partnerships. And it's something that a really interesting academic called Daniela Gabor, whose work I highly recommend, calls the Wall Street consensus, which is effectively a way to use the power of the state and, public funds to backstop private investments. So rather than just having direct public investment in public infrastructure, what the infrastructure bill does in a lot of cases is offers ways for the US government to basically like backstop private investments in infrastructure. So to find ways to incentivize and encourage and guarantee the profitability of private investors working on sort of public infrastructure projects. And that's a huge sort of pet project of Larry Fink's. He loves that as a concept. And a big part of that comes down to, the way I first defined green capitalism, which is constructing sort of new areas for profit making within the green transition. And no one is better at that than BlackRock and private finance more broadly.
And one of those constructions is ESG funds, right? We're hearing so much more about ESG investing lately. So what is it?
Very good question. So ESG has become quite a big kind of nebulous term, but it sort of stands, well, not sort of, it stands for environmental, social, governance investing. And what that means is that you construct your portfolio in theory based on, concerns around those issues. So that might mean that you don't want to invest in coal mining companies. It might mean that you make sure that companies have a policy for having women in the boardroom. These are hugely different issues, but they're all kind of covered under the ESG banner. And it's exploded in popularity over the past few years. It's really popular. Polling shows, particularly with millennials and younger people just starting to invest. I think, they're much more interested with the idea of like not just getting rich, but trying to do something good in the process. And ESG had an excellent pandemic. It had, record kind of bumper years throughout the course of the pandemic, outperforming, the market as a whole. And a lot of people took that as evidence of this idea that as we go forward, the best way to do well financially is to do good in the world. And so that's basically in a nutshell what ESG investing is. It's this idea that, not only is it good for others and the planet for you to invest this way, but it's also good for your portfolio.
And those ESG funds, obviously it matters what companies make up those funds. And, for a lot of people, I imagine when they think of companies in the environmental, social governance fund, they'd expect them to be clean energy companies or some other company whose product directly leads to decarbonization or environmental sustainability. But in reality, what kind of companies actually make up the largest portions of these funds?
Yeah, so this comes down to a really interesting kind of feature in the design of ESG investing that I'll come back to. But a great example of this is, Vanguard's flagship ESG fund, where at least the last time I checked, which to be fair was a couple months ago, but at the height of the pandemic, when this fund was, lauded for massively outperforming its conventional kind of counterpart, the top holdings in the fund were Amazon, Facebook, Microsoft, Apple, and Google. So just, 5 big tech companies. The first even like remotely kind of climate related fund company was Tesla, which came in at 6th place. And, the incredible thing is those 6 companies together took up more than a quarter of the value of the fund. So, a huge amount of this massive fund was just like floating around in the shares of Facebook and Amazon. And, these aren't exactly firms that are, directly, mining or extracting oil from the ground. However, they're also not firms that are really doing much, if anything, to contribute to the climate crisis. They have a lot of socially questionable track records, many of them, I will say, without trying to, be accused of libel. So I think a lot of people would be surprised that that's sort of the general approach, but that is really true of the ESG industry as a whole. I've done a lot of research, again, with Commonwealth, and the same is true of the UK. So most ESG or even climate specifically themed funds in the UK are just chock full of big tech and financial firms, again, with no criteria over whether those financial firms might be lending huge amounts to the fossil fuel industry. And clean energy and utilities companies are a tiny fraction by comparison. And I think, that's surprising to a lot of people. And there's this idea that like greenwash is a big problem in ESG and needs to be called out. So clean funds holding fossil fuel firms. And, that is definitely a problem, but I think, that's a problem more on the consumer side. So like being honest about what you're selling, it's actually, to me, not as relevant from the climate perspective. And this comes from maybe a cynical position, but one that I think is accurate about ESG's actual role in doing anything about the climate crisis. And so, a big part of the reason that, that Vanguard fund that is supposedly ESG and climate aware is just like chock full of tech companies, is that this is, again, coming back to that approach that's based on minimizing the risks of the climate crisis to finance, as opposed to minimizing the role that finance has in driving the climate crisis or maximizing its role in trying to solve it. So when it comes to sustainable finance and this kind of idea of doing well by doing good, It's all fine and well to want to not invest in fossil fuel companies. If that's your principle, I think that's great. But I worry that this creates this veneer that, by this explosive rise of sustainable finance, that we're solving some kind of problem that has a real impact on the climate crisis, as opposed to just minimizing risk from exposure to coal mining companies, which might be failing. And again, that's fine in and of itself, but let's not act like ESG funds are really materially changing the way that companies operate, or really, really changing the nature of our economy and its reliance on fossil fuels. One of my favorite examples in an ESG fund was someone did a really interesting study of hundreds of funds that are based off of an index called the Russell 3000, which is just 3,000 mid-sized companies. And they compared them to ESG funds based off that index. And they found that the single biggest difference between the ESG and the mainstream funds based on that index, by several orders of magnitude higher than any other factor, was that the ESG funds mostly selected for companies with few or no employees. And they tended to have the best social ratings in the ESG criteria, because if you have no employees, you can't have any labor disputes or other social issues. So that, I think, is a really great encapsulation of this logic, which is, this is about minimizing your financial risks and not about using financial power to drive physical material change in the economy.
Yeah, it's ultimately should come down to impact, right? And it doesn't seem like that's that's how it's going. I think what you just described, that's part of it. But I think another really important part of it that you describe in the book is what's actually happening with this money. I mean, you've talked about the explosive growth of ESG funds, but does this increase in its popularity and the size of these funds directly correlate with an increase in investment in these companies that are actually doing good for the planet?
Yeah, and that's a great question, and comes down to, I think, this foundational myth we have about what the stock market does. So an example I talk about in the book, and I'll unpack it here with your permission, is the example that hopefully many people might remember of GameStop during the pandemic, which was an event where a number of kind of vigilante types on the website Reddit, a Reddit subpage called Wall Street Bets. Someone had noticed that a couple hedge funds had bet against the stock of GameStop during the pandemic, because it's a sort of storefront retailer. And they were like, it's a pandemic, everything's shut, this company is going down. And so they had shorted the stock, which means that they had bet on it dropping effectively. And having noticed that, the people on Reddit decided they would all band together and just buy up tons of shares in GameStop, and hugely drive up the stock price. And it was, unbelievably successful. I highly recommend Googling a chart of the GameStop stock price, because it's just this ridiculous upward kind of precipitous cliff that was all just, undertaken by a bunch of people on the internet. And I think I find it to be a really helpful example about the kind of inherent irrationality of the stock market, and the fact that, we think of it as this vehicle for share prices to actually reflect, the productivity or some kind of meaningful criteria related to a company. So, if you have a high share price, it means that you're actually doing something really good and you're highly profitable and all of these things. A lot of the time, that's just absolutely not true. There are tons of companies that, for which that's not the case. And Tesla was a great example for a long time, hugely inflated stock despite all sorts of actual practical issues. And so a lot of the time it can be based around, complete irrationality. And again, that's fine. You can just let it go be a casino, I guess, kind of by itself, where people can speculate and try to make money. But the issue is that it has this kind of sort of central role as somehow an indicator of, one, the value of the company in material terms, and two, the health of our economy. And the second part is that, the vast majority of activity that takes place on the stock market is not actually if I buy a share in Tesla, I'm not, buying £5 of Tesla stock and giving Tesla £5. because the vast majority of what's happening on the stock exchange is that it's just effectively like bits of paper or digital kind of information trading hands between investors. And, very little of what actually happens is injecting new capital into that company. That really only happens at the IPO, which is their initial public offering. So the first time they list stock on a stock market, or, in relatively infrequent instances where they decide to issue new shares, like an existing company might issue a few more shares to raise additional funds. So very rarely is your investment actually like doing anything material for the company itself, maybe slightly adjusting its stock price. And that, I think, is another big kind of issue with ESG, right? Is we have this idea that like, I'm buying the sustainable fund and my money is going to this company and that's going to do something to change the company's behavior or, support its activities. But it's really just a way for you to sort of place your bets on the likelihood of a sustainable future rather than actually like invest in trying to build it. Because it really comes down to, money changing hands between people on these kind of secondary markets. And yeah, that's kind of like, I think, a big myth about the stock market that is really enduring, I think, in like the public consciousness.
Yeah, I think that explanation is critical to truly like understanding what's happening with ESG. I think someone else who might want to have a little bit of a better understanding of what's happening with ESG is our former vice president, Mike Pence. He wrote in a May op-ed in the Wall Street Journal that the woke left is poised to conquer corporate America and has set in motion a strategy to enforce their radical environmental and social agenda on publicly traded corporations. In your assessment, has ESG accomplished Mike Pence's claims?
If only. God, I wish I lived in Mike Pence's imaginary. No, I think, ESG in part has become so hugely popular. One, I think, it reflects public and consumer demand. And that in and of itself, I think is good. It shows that there is like a shift in consciousness about how people want to invest or spend their money. But another big part of it comes down to the fact that like corporations have come around to the idea that this is probably a profitable domain for them to be in. And again, this is the kind of green capitalist logic where, this is a way for them to sort of market themselves as green and socially responsible without really having to do all that much. And that's because a big part of ESG just comes down to this idea of disclosures. So a huge amount of the way that decisions are made on ESG funds, for example, is often based on criteria like, do they disclose what their carbon emissions are, or do they disclose how many women they have as board members? And that's a really easy task to do broadly compared to, actually aligning your, business model with a 1.5-degree trajectory, for example. And so I think, there's this big shift within the corporate sector itself voluntarily, as opposed to like bowing under the pressure of the woke left, which is that, this is a relatively straightforward thing to do. And we think that, our exposure to these risks can be minimized in a way that actually, opens us up to more stable long-term returns and profitability. So it's definitely not some kind of like woke left success or, this altruistic kind of inherent goodness necessarily on the part of corporations and private investors. I think it's this idea of this kind of like win-win where they can look great from a marketing perspective, not really do all that much in terms of changing their behavior, and feel as though they've also found a way to maybe limit their exposure to certain kinds of risks. So it's good for them all around, I guess.
So why do you think the political right is so opposed to ESG investing?
I mean, that's a really good question. I wish I could climb inside Mike Pence's head. I also don't, but
I don't think you do. Yeah.
Just for 5 minutes. No, I mean, I think it's possible that part of it comes down to this like ideological opposition to the idea of like interference in markets, which is in and of itself hugely ironic because, no markets are free. There's a huge amount of existing interference and construction and market making by the state. But this is a particular kind of interference that I think the ideological right is averse to because they see it as having some kind of like leftist agenda. I think it's interesting that kind of opposition is really coming from truly an ideologically based right, whereas the kind of more financially and fiscally conservative, but like relatively centrist, right? So, your diehard capitalists are often like really cohering around this idea because it does nothing to violate, fundamental conservative or capitalist principles, really, unless you are truly ideologically opposed to the idea of climate change existing or, any kind of interference in the free market. There's no logical reason, as someone who, might be a huge advocate of markets and capitalism, there's no reason not to engage with this, which is why you've got, the Larry Finks of the world, becoming huge advocates for it. So I genuinely think it can only really come down to some kind of ideological opposition because, materially, it's not driving a huge amount of difference. And, it doesn't really violate any kind of like good business sense type principles or approaches to politics and economics.
Well, I mentioned in your introduction that you're the senior research fellow at the think tank Commonwealth. What's the goal of Commonwealth?
So Commonwealth has a space in the middle for anyone listening, and we're incredibly hard to Google as a result of that. So we're not Commonwealth as in, the Commonwealth, the imperial enterprise, but common space wealth. And that is an intentional play on words because what we're focused on is building a democratic and sustainable economy. So, holding wealth and, the corporation in common governance structures rather than structures that are based on kind of hierarchy or, narrow executive management or all these kinds of things. So we're really, really dedicated to the idea that the best way to go about achieving an economy that works for everybody, that is fair and that is sustainable, is to have one that is much more democratic than it currently is, where everyone can have a stake and a say in how things are run. And so we kind of propose models for doing that. And we work on issues like corporate law reform, but also on asset management, on community wealth building, on lots of things, basically. Anything that can be publicly or democratically owned and controlled, we're interested in it.
Well, we will link to Commonwealth's website in the show notes, so you don't have to Google it. You just click right there and it'll take you to the site. We will also link to the book. I mean, we just scratched the surface of the value of a whale in this conversation. So if you want to learn more about Adrienne's critiques of capitalism or green capitalism, definitely check out this incredible book. Adrienne Buller, thank you again for joining the Climate Pod.
Thank you so much for having me. This was great fun.